Welcome to Buy, Hold, Sell. I'm Ben Clark, and today we've got Justin Braitling from Watermark, James Miller from Firetrail, and we're going to talk about some defensive equities to own. The correction is on, and we're all probably looking for some businesses that can grow their earnings regardless of the business cycle. So, James, I'll start with you. Sydney Airport, one of the bigger ones. Buy, hold, or sell?
It's a hold for us. Sydney Airport, great asset. It's probably at least a decade until we get a second Sydney Airport, but just in this rising rate environment, these infrastructure names could come under some pressure.
Yep. So-called bond proxy. Do you like this one, Justin?
I'd agree. I think it's a hold at these levels. I mean, the recent traffic numbers were a bit soft. Yep. With the currency where it is, outbound travel is going to struggle, I think, in the months ahead. You've got the Productivity Commission report to be released soon, and there's some concerns around the sort of returns that Sydney Airport are generating. So I think it's a hold.
Okay, well, let's stay in Kurnell. Caltex next door, but morphing into a retail sort of business. Is buy, hold or sell?
They're offering sushi and everything now, dry cleaning. I think Caltex is probably a hold here as well. Yep. Again, we're seeing some of these consumer patterns unfold, which are a bit disturbing. Premium fuel volumes were down in the last half. They made a lot of money in driving premium fuel through their canopies, and so that's up, that's done, and the volumes now are slipping. Refiner margins look okay, I think, in the medium term, so it's probably a hold.
Yep, okay. Management's done a pretty good job with a very tricky business. What do you think on this one, James?
We like Caltex. It's a buy for us, and the market did get concerned post-results. I mean, it fell after they didn't come through with capital management, any plans there, but we're looking at a company that's a $7 billion market cap, got about $2 billion of property value, and then it's trading on about 11 times PE. So to us, it's a cheap defensive asset that is a great buy for us.
Okay, and we'll jump into the funeral markets. It's quite a leap. Invocare, potentially we're going to have a negative death rate this year, which is quite unusual. Is this the time to buy Invocare?
Invocare's a sell for us. We're seeing their margins declining. We're also seeing them spend more capex. So competition in that space in terms of funeral homes has really increased. They're having to spend to upgrade their homes, and that creates earnings pressure for them, balance sheet pressure possibly as well. So no need to be there. Okay,
Justin, I saw the CEO of Propel today said there hasn't been 2 consecutive years of negative death rate since 1990. Is it time to get into Invocare?
We need a good flu season, don't we?
Yeah.
It was a benign flu season.
And a cold winter.
Yeah, cold winter, cold snap. I'd agree with James, it's a sell. They underinvested in the business. There's a lot of catch-up spending going on now, but it's a very benign volume environment, growth environment. There are no more acquisitions to do. I think they announced an acquisition the other day of $2 million or something. That's how thin it's getting. Yeah. So I think that's a sell.
Okay. I haven't got a buy out of you yet, so have you brought along a good buy idea in the defensive area of the market?
Well, I think it is time to look at the defensive sectors, and you want a defensive industry that's got a bit of a tailwind, and I think the grocery retailers at the moment have got that tailwind. You're starting to see a bit of food inflation come through following the drought, and I think you're going to see a more benign competitive environment as well. Aldi have stopped rolling out stores. Amazon are still, years away from having any impact, and so I think Woolies is well positioned.
Okay, that's good. And James, what have you got for us? A defensive stock that can grow over the next few years in a bit of a volatile environment?
Yeah, similar in that consumer space. Amcor's a buy for us. It's a company that used to trade on 20 times price to earnings. Now, if you look 3 years forward, it's on about 12 times. And it's had a tough couple of years. Raw material costs, resin, increasing there, hurting earnings, but looking forward at that valuation and also what they've done with the great acquisition of Bemis in North America, it really is the truly dominant global flexibles packaging player now, with some defensive earnings as well, at a cheap valuation with earnings growth. It ticks all the boxes for us.
Okay. Well, look, everyone needs a bit of defence, and there's a couple of stocks that have struggled in recent years, but they both seem to be coming back, so well worth having a look at.